First thing I do every morning is I look at the US 10-year Treasury yield. So blue line is the US 10-year Treasury yield, and the red line is the mortgage rate. You can see from the graph that two moves almost correspondingly, synchronized pattern. And so if the blue line rises, which 10-year Treasury constantly changes, that means most likely mortgage rate will be rising. So that's why I look at it. So US government, by the way, my office is in Washington, D.C. I am working remotely from home in Arlington, Virginia. But Washington, D.C., they're collecting in a record tax revenue right now. But they spend more than that, so there's a budget deficit. So how does the government manage that extra deficit? They borrow money. And the interest rate that the government pays is in essence the blue line. So government pays that blue line, and as you can see, mortgage rates are slightly above the government borrowing rate. But I want to see the direction just by looking at the blue line. But the blue line has its own resistance point and things like that. And again, is at that critical point whether it's going to break or not whole, but that's where we are. As you can see, there is slight spread between the red and the blue. And let me zoom in on that point. So this is the spread between the 10-year Treasury and 30-year fixed rate mortgage. So historically, the spread is only about 1.5 point or 2 percentage point difference. Put it simply, if the government borrows at 2% rate, then the mortgage rate will be about 4%. You just add 2 percentage point. So government is currently borrowing at 4%, which means that mortgage rate right now today should be 6% and not 7% under normal spread. But mortgage rate is 7%. Just consider your clients, how they would benefit if the mortgage rates were at 6% rather than at 7%. But we are at 7% because spread is larger than normal. I put that two little circles to indicate there are a couple of periods when the spread really widened than the normal condition. The first one, in the middle of the graph, that occurred when Lehman Brothers went bankrupt back in 2008, right before the Great Recession, causing huge panic, potential bank runs and things like that, so that the spread widened. The second circle is March 2020, when we were hit with COVID. People did not know what's going to happen, so that also led to larger than normal spread. In other words, time of panic, alarm, then spread widens. But look at today's spread. First, is much larger than even those crises. And second, it's not anything panic or alarm. Of course, the economy is, teetering on recession. It's not right, but it's not like sudden changes like, massive bankruptcy by a Wall Street company or a COVID coming into the country. So very unusual. So we are talking to policymakers here in Washington to say, why is this occurring? Explain to us what may be happening. Is it possibly some market power among mortgage servicers leading to this condition? Or is the Fannie and Freddie, which are essentially government agency, are they doing something funny? So we want to know why, because it's clearly abnormal spread. If it's normal, your clients would be much better off. 6% mortgage rate compared to the 7% that we have today.